Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this interview excerpt with Brad Thomas. Well, let's shift to the more positive side of things and say, what was your biggest victory of 2016 and what helped set you up for that success?
Part of what I enjoy doing, it's always great to hit these home run pitches. But I just like hitting singles and doubles. That's really what I do. That's my day-to-day job. And I just, Core Energy was a great pick. We got in at a good time.
And what's the ticker on that one again? I'm sorry.
Yes, I'm sorry. Core Energy's ticker CORR. It's an energy-based REIT. Obviously, energy's in the name. Small cap, a lot of volatility, externally managed, so a lot of notable risks with this company. But it was trading at a very substantial discount. So we stayed on that one throughout the year, and that one generated 160% total return or something ridiculous like that. And then we still got the company in our coverage. We still got to buy on the company. But again, that's really not what's important for me. We only had a modest exposure with this particular company. Typically, if I've got a company that's under a $500 million, even $1 billion market cap, that could be a pretty volatile company. So we try to maintain around 1%. It's just a very modest exposure. Again, I think my successes for last year and really every year are the singles and doubles. When you invest in real estate, you invest in real estate for the long term. When I used to build shopping centers, I didn't build them to flip them. It was, certainly I did flip some as soon as I built them. But you build on the premise that you're going to own this property for a long period of time, and your wealth is going to be created through the power of compounding. And what that means is through the power of the rent checks that are accumulated over long periods of time that creates the appreciation. So when I look at the REIT space today, to me, the successes were the companies that were able to generate 10% returns. So break it down, 5% dividends and 5% growth. And that's, to me, that's a success. Realty Income, which, as you know, ticker symbol O, is one of the REITs that I write about, talk about quite a bit. And it's just your prototypical sleep well at night company. It's going to generate, on average, 5% dividend growth. Obviously, today, we're not getting 5, we're getting low 4. But you're getting a 4% dividend today, and you're getting 5% growth. So you're going to get, there's nothing wrong with investing in a real estate company that's in the security wrapper that generates 10%, total returns a year. That's kind of what I sign up for and what most investors sign up for. I'm not a big fan of market timing, as you well know. And I think most investors that I talk to own real estate for the same reasons that I do, and that is for the predictable income and the modest share price appreciation. So, I think we had a lot of successes in 2016. A number of companies in our durable income portfolio generated returns that were in excess of 10%. And again, that's if we're hitting that benchmark, then I'm happy. I'm a happy camper.
Well, and as we'll get to one of the questions later on in this interview, we'll note that based upon what a lot of DIY investors are getting on annual returns, being able to hit singles that are averaging 10% a year would actually be big wins. It may not sound sexy or exciting, but when you track that out over a number of years, that's a really big deal. So I appreciate you making that point. So if you were asked to give a state of the market speech to U.S. investors going into 2017, what would your main points be?
Well, again, I have to always mention our president-elect, which is obviously November 20th or January 20th will be in office. So, Donald Trump is obviously a big part of that. Now, as you know, I wrote a book on the subject and called The Trump Factor, which is doing very well. It's a business book on Donald Trump. And I want to make that clear because, from time to time I'll hear people want to talk politics, and I don't mind talking politics, but that's not my wheelhouse. I'm a business writer and specifically real estate. So I think Donald Trump's going to have a pretty big impact, arguably, as it relates to real estate in the United States. I mean, this is the first president that's ever had that much, real estate experience and wealth that's been created. I think you really go back over time and, maybe Jefferson owned a lot of land and he created a lot of his wealth in real estate. John F. Kennedy's family created the wealth, but Kennedy ended up with a pretty sizable inheritance as well. But nothing is comparable to Donald Trump when we talk about real estate and the power of wealth creation in real estate. So I think having Trump in office is going to be a great thing for real estate. I think it's going to extend the life cycle for U.S. real estate by perhaps, a number of years. And we're already seeing a number of his hirings in his cabinet and within his administration. I just wrote recently about Dr. Price, who was brought in to run the health administration for Trump, and he's a physician by background. But I think one reason Trump brought him in to the administration was because of his not only his background in healthcare, but also his more recent experience and really belief of keeping things simple and not having high regulation. So, I just wrote on this again as it relates to the assisted living REITs like Omega Healthcare, ticker OHI, or Care Capital Properties, ticker CCP. One of the reasons we're seeing a lot of mispricing, and we have throughout 2016 in those spaces, in that sector, is because of the complexity and the regulations that are making it very, very difficult for the operators, assisted living operators like Genesis, public company, ticker GEN, those companies to maintain profit margins. So I think by simplifying the business model at the government level, I think it's going to help impact some of these operators, which will in turn, I think, impact the shares of REITs like Omega Healthcare and Care Capital Properties. So going back to the state of the market, I think it really comes down to Donald Trump is building an administration much like he built buildings when he brought in architects, engineers, contractors, bankers, surveyors, to build out companies. I mean, he is highly involved in building out the team, the blueprint, if you will, which I refer to it in my book. And I think the biggest thing is, we see with Trump is that he is because of his background as a developer, and this also applies to me, frankly. I mean, I think that's one of the reasons I enjoyed writing this book, because I was a developer just like Donald Trump. And I could see firsthand how he was able to value engineer his real estate portfolio, and look at every line item and every cost to save money. And, he would create the highest quality product, but at the lowest cost. And that's the mentality that he's bringing to the White House today is much like a value engineer, where you're going to see him, try to cut costs in the administration, but also deliver the highest quality results. So I think that's how I would sum up, 2017. I'm certainly kind of overwhelmed that he did win. I've had a lot of, and I was there. I was there at November 8th at election night and stayed up until 5:30 in the morning. I was there with my good friend Andre Bauer. Andre is our former lieutenant governor in South Carolina. He's a CNN correspondent, and he's still on CNN quite a bit. And we were sitting there till 6 o'clock in the morning. It was just surreal. When I got back to the hotel room, I was just still it was like a dream. I knew Trump could win, Brian, but I don't think anybody really knew he was going to win. And it's just kind of amazing. So I think you're going to, I really believe as it relates to real estate, it's going to be a positive. I don't agree with all of the policies that Trump has been talking about, but I think overall, from what I've seen so far, I think we're going to see a lot of good positives for the real estate world. And again, I think because Donald Trump's bringing that kind of value engineering mindset to the White House, I think that's going to produce some really nice dividends for not only REIT investors, but just Americans in general.
Well, in light of all that, so how are you've kind of tipped your hat to this a little bit, but how specifically are you positioning yourself for this as we start 2017? Maybe things you're excited about, you're concerned about specifically. You mentioned some retirement centers and things like that. What else what are you excited about and concerned about? I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.